The owner is in the business of investing in an asset and a business at the same time. So the asset is the physical hotel itself, a piece of real estate, piece of land, and secondary to it or within it is that operating business, which is the hotel side. And there's various ways that those are valued. You know, you might have a branded franchise hotel that perhaps could be worth maybe a little bit more than an independent because you have the power of that reservation system, for example, a Marriott or Hyatt or IHG reservation system driving it, or a Hilton system. And then, you know, you look at it from simply a real estate play, there's X value on that, and then you have Y of the business. Well, those two things are driving the value of this physical asset, and it could be multiple, right? That owner maybe owns a whole bunch of hotels, a large portfolio. So from the owner's lens, you've got to think about what are they really caring about? Obviously, you know, you could talk about the soft side of the business being like, you know, we're good community partners and we want to run a great business for whatever community I'm in, and that's fine. But then there's the real side of the investment side, right? And investment side is always going to speak to the V word, value. And it's the most important thing that I talk about. And it's something that I don't think is talked about enough in our space. We often get back to, you know, servicing and delighting the guests, which is all a part of this equation, this value equation. But owners care about the value of their business and their asset. So I know I've spoken to you about it. I speak to a lot of CEOs of companies about that are touching our space, the hospitality and hotel space, is how do you create value? So let's talk about that correlation between that management company to that ownership group and how that management company can positively impact value. And truthfully, that ownership company, you know, again, beyond just the soft feel good, hey, we're good in the community, how can I find, as the owner, more value out of my business, out of my asset? Well, let me tell you, there's no secret sauce here, but there's certainly a recipe. And that recipe can come in many forms. And one of them is through creating more NOI. And NOI, net operating income, that's what the value, when we talk about how I value my asset, my hotel, if I drive more NOI, I'm driving more value, right? You know, when you look at the valuation of a hotel or a portfolio of hotels, they're looking at one thing first, and that's going to be the operating income. The real estate is going to have a value to it, and we know that, and it's going to vary based on market, A+ location versus a C+ location. These are all factors. But when I think about the business side of that, I think, how can I create value? And in today's markets, in today's, you know, macroeconomic level for the hotel space, there's some consistencies and some congruencies, and one of them is expenses continue to rise. We know that. Labor, being the biggest cost in hotels, continues to rise. Wages are up, insurance costs more, the benefits themselves have gone up year over year. Labor is more difficult to come by. So therefore you're paying a premium to find and get that labor. So you think about the recruiting process, the hiring process, all of this costs more. Then the secondary part of that is all your direct expenses that are happening in your hotel. So if you're operating a business like a hotel, you're going to have your, you know, room supplies, your linens, you're going to have all your food and beverage and the correlated cost to that. You're going to have all your fees. We're paying credit card companies to process credit cards. We're, you know, if you've got landscaping and maintenance and all this upkeep, well, there's one consistency that you'll find about all them, and those are that they continue to rise, these costs. Now, something interesting is, you know, when you're in a market, and much of the US, if you look at all the leading groups that do forecasting and projections for future dates, when you're looking at 26 projections, you're seeing a lot of markets that are either going to be flat, and in some cases, revenues on a downward trend. So you've got a recipe that could really negatively impact value here. You've got revenues staying stagnant or declining. You've got expenses increasing, and what's happening here, Ethan, you know as well as anybody, you're eating into margins. And that same business that you ran a year ago, today, even at the same level, is making less money because my expenses continue to rise and revenues are staying pretty flat. And arguably, even in the select markets where it's going up, they're not increasing at the clip that the expenses are. So now we run into a real interesting quandary because you're the management company. You've got an owner here that expects certain returns. And now you go, how am I going to create value for this owner when everything is going against me here? I've got bad revenues or you know, stagnant revenues. I've got increasing expenses. This is where the proposition of technology, innovation, and solutions comes into play. Using Acra is a perfect example. If I've got a hotel where I'm experiencing this expense increase, revenue staying flat, and I've engaged Acra and they've found a way for me to create a new revenue stream in my hotel by using this parking spots or even my parking deck that's been sitting there either underutilized or not utilized at all. And now, because of its strategic location and its proximity to whatever that demand generator may be, an airport, a cruise port, whatever it might be, all of a sudden, I've uncovered a new revenue, a new income stream for my hotel that was scraping to make the same margins as last year because of all the points we talked about. So now, as the owner, I'm going, okay, I see what's happening here. The management company's now, and the management company's also looking like a hero because now they figured out a new way to create an income stream, which, by the way, doesn't have a direct expense tied to it, which means if I'm making $1 on that top line revenue and I can flow 95% of that to NOI, to the NOI line without having to have, tied expenses and fees and everything else to it, this is so much more impactful to the value than anything else.
That's phenomenal. Okay, so there's an asset value formula. Can you walk through what that looks like and how NOI and cap rates tie into that? And if let's say a company brings in an extra $200,000 or $500,000 of NOI in a single year to an asset, what impact does it actually make for the asset owners?
Yeah. It's I'll use a specific case study here, but a hotel, $40 million valued asset, let's call it. It's got a great parking deck or a surface parking that they're not really using, and they're generating X amount of income. Let's call it $2 million a year in net operating income. If I were to look at that hotel and value it, I'd base it off that $2 million of NOI. I'd certainly look at the market that it's in, which is going to impact the cap rates, capitalization rate. The net operating income, though, is going to be the big driver behind that. So if I'm looking at it and I say it's $2 million and the cap rate in that market is 7-8%, I can come up with a pretty quick exercise here to get a value of that hotel. Now, in that same breath, if I'm using Aqua, for example, and I find myself an incremental $250,000 a year in income that goes 90% of it to my NOI line, I've now just created $230,000 to $240,000 annually of new value. So if I use that same cap rate and put it over 5 years, I potentially just created another $1.5 million to $2 million in value just by adding that parking income stream now to mine. So again, that's a very straightforward, dry example. Now let's talk about the fact that many owners are going to have multiple assets. They're going to have many of them in markets where, perhaps that 250 ends up being $500,000 a year. And I put that multiple over a portfolio of 10, 20, 30 assets. It's not unrealistic to say I had a $500 million value on my entire portfolio, and I just added incrementally 30, 40, 50 million in value because I have free cash flow coming in from my new income stream of parking, for example. So that formula can be impacted so greatly by creating a new revenue stream that it runs, 90+% margin on it, straight to the NOI line, and that valuation when that owner is going to go for a refi or when they're looking to exit and sell the portfolios can have huge impacts on the value of their portfolio.
It's unbelievable. Yeah. And that it has profound changes to the industry at a time when, as I'm hearing from you, we have RevPAR, or revenue per available room, is staying flat or actually decreasing in some cases. Yeah. You have expenses rising, so profits getting compressed. So NOI, therefore, is having a negative impact as a result. And so now you look at these management companies who are bringing in these technology providers who are able to drive incremental gains to NOI with very, whether it's, I saw some stat at the lodging conference, like 6% of ancillary revenue flows to the bottom line. Still great, right? But it's, you're talking about parking where you have 70, 80, 90% margins and flow through. And so if you're underwriting an asset and you're an owner, that has to really change your math equation.
Yeah,
right.
It absolutely does. And when you're talking about 6% margin, I mean that's just some shrinkage and some loss away from being break even or zero. So you're really making, all this effort and work to make zero gains, right? That's why it's important to think about things like the parking I referenced where, if you mention flow through, if it's an existing parking lot that's already sitting there, it's a part of the asset that's probably already paid for. It's unused space, and all of a sudden now you create income out of it. This is like the double win because you're getting a new income stream The margins are going to be ridiculously high, much higher than, perhaps adding a new F&B outlet or anything else that's going to have costs and expenses tied to it. So the value creation becomes absolutely huge in this case. I would also say that when the owner's now looking at the underwriting, I've underwritten hundreds of hotels in my career, maybe into the thousands. And when we talk about, and I'm going to use parking as an example, when we talk about parking, we always look at things like capture rate, and we'll assign a revenue per occupied room and just say, okay, if we're lucky, we capture 33% of the guests, so a third of all hotel guests, and I'm going to capture $5 per room, whatever it might be. And you're making all these assumptions and probably conservatively underwriting from your perspective of hey, this is an optimistic number that we're going to hit. So you're doing it conservatively. Now, if I've got a solution like this, like Opera in this case, I've got an RMS system in place. I have real-time insight of what people are willing to and actually paying for parking, real numbers to gauge of how much parking I'm actually collecting. And now I can either conservatively or aggressively, depending on the type of owner, put a number in there that I feel good about when I'm doing my underwriting and I'm looking to get a valuation done. Particularly in the case of today, when you have owners who have purchased in the last 5 years and they're coming up on their notes maturing and they've got to go out to market to either refi or restructure that debt, for example. They want to squeeze the most value they can get out of that asset, and they need real numbers to go on. This is the importance here.